Hello and welcome to the i3 podcast, Conversations with Institutional Investors. My name is Wouter Klein and I'm the editorial director for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. That's the letter I and the number 3-invest.com. There, you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners from around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice and is intended for institutional and wholesale investors only. Please enjoy the show. In this podcast, I'm speaking with Dan Farmer, who is the Chief Investment Officer of MLC Asset Management. We talk about Dan's early days managing an internal Australian equity portfolio and getting involved with derivatives at Telstra Super almost straight out of university. We talk about some of his mentors, including Steve Merlicek, and the influence they have had on Dan's investment philosophy. We also touch on the merger between IOOF and MLC and the new capabilities this has brought to his team. Dan, welcome to the show.
Thanks for having me. Pleased to be here.
So tell me a little bit about how you got started in investing. I had a look, of course, at your CV, and you spent 17 years with Telstra before going over to IOOF. Tell me a little bit about how you got started and what some of your key moments were at your time with Telstra.
Yeah, look, how I got started. So I was doing my Masters of Finance at Melbourne Uni. So I was in my fifth year of study and thought I'd better grow up and get a job and actually start earning some money. So I started looking around and I got a tip-off from one of my college supervisors about a role going at Telstra Super, which at the time the CIO was a guy called John Simkus. So I went over there, got a job at Telstra Super, and it was fantastic. Great time to enter the industry. The super industry in Australia was really in its infancy. I was, imagine, a graduate out of uni, and I was straight helping out dealing on a small Aussie equity portfolio that the group was running, probably one of the first internal managements going around in the Aussie super industry. So great learning curve, really sort of cut my teeth on that Aussie equity portfolio. So it taught me a fair bit of humility. It's not easy running a direct Aussie share portfolio. So I think that set me in a good stead about how the industry actually operates.
So you said it taught you some humility. What do you mean? What are sort of
it
examples
is
of
tough to outperform the market.
Yes.
If you're sitting on the outside, it's very easy to throw rocks and say, well, you should be outperforming in this market and be quite critical of managers. We are critical of managers, but I think it gave me an insight on the nuances of running a portfolio. It gave me a good insight onto risk. And look, I think I was very lucky starting off with that role. It also, part of that portfolio was using option strategies around individual stocks to provide some protection. So that also gave me probably my first taste of sort of asymmetric risk and using options to control risk.
So thrown straight away into the deep with options and derivatives and
yeah, it wouldn't happen today. It wouldn't happen today. This was back in the early 90s, but had a really good boss in John Simkus, who used to be sort of head of research at UBS Australia. So it was a great start. And look, milestones at Telstra Super, as I said, the industry was in its infancy. So I think when I got there, the portfolio was 2 balanced managers. That was
right.
it. It might have been BT and Schroders. So I really went through the whole evolution of moving from balanced managers to specialist Australian equity managers, specialist global managers, specialist fixed interest managers. So, that whole exercise, working with consultants was a great time to sort of be entering the industry. And then Telstra Super also went from purely a defined benefit fund to an accumulation scheme. As Telstra was reshaping its workforce, you could just see members leaving the DB fund, and we sort of set up an accumulation fund, which was a little bit novel at the time for a corporate super fund, but was very successful, and that's obviously a huge part of the Telstra Super Fund as it is today.
Yeah, and I think your main role was looking after equities. Why equities? Why did you start there?
Well, to be perfectly frank, that was the job offer. So that was my toe into the door. And look, I did love the space, and it was Australian equities, which was very relatable. I think it's a great spot for new people to enter the industry because you can relate to the businesses. It's tangible. The management of those companies are very proximate. So I was a young, early 20s guy meeting CEOs of big Australian businesses. It was a fantastic sort of learning curve, and I think I learnt a lot more sort of in the direct Aussie shares to start with, and then really put me in good stead with the managers, and it was a terrific spot. I mean, active management was certainly dominant back then, and there was some great Aussie equity managers going around. I think one of the first appointments I made was Perpetual when it was just coming out of the trusteeship. So I did that search with Jana, and really had good access to those managers.
Yeah. So how did those first company meetings go? I mean, did you feel that you were taken seriously, or did you have to build up, some slick...
I felt like I was being taken seriously at the time, but on retrospect, I probably wasn't. But that's all right. So no, look, those meetings were great, and really, I think the industries back then it was probably a bit smaller. There was a bit of an acceptance of new people coming into the industry, so I'm sure I asked a lot of pretty naive questions at the time, but good respect. But it was interesting because we also, when we're running direct portfolios, going into a lot of smaller companies as well, and they're very hungry for capital. So it was a really good dialogue with a lot of those sort of CEOs and management teams.
Yeah. So do you feel that gives you a different perspective on, now as a CIO of a large company to had that experience of like boots on the ground and talking to management themselves?
I think it does. Like at the end of the day, when we're investing, obviously as you climb the ranks of an investment team, you probably become less and less proximate to the actual investments. So a reminder at the end of the day when we're investing in a index, whatever global equity index that is, ultimately that's a series of underlying management teams, a series of underlying business strategies, and hence one of the sort of, I guess, philosophical beliefs that I've sort of built over the year and we run in the team is a belief in sort of active investment management in all its forms, be it being active with asset allocation, using active managers where it makes sense in that particular asset class, being active with currency, active with style selection. So I think that sort of grounding in direct shares and the fact that it is a very differentiated asset base and there's a lot of idiosyncratic risk in there sort of really filtered up, throughout my career into sort of how we think about managing money today.
Yeah. Do you see a change in sort of the role of active management today as back when you started? Because we obviously seen a lot of changes in markets, in the super system, new regulations coming in with your future US Super. What is your current view on active management?
Yeah, look, still see very much a role for active. I mean, the industry has changed and it's a big topic, particularly at the moment where there's obviously at the moment high concentration in equity markets and the concentration is correlating with some high valuations. So it is putting some challenges on active management at the moment. Now, I've been around long enough to see a few cycles of different forms of this, and I sort of remember the 2000s where, we had a similar concentration, wasn't quite as high, but, very similar in the sense of valuations high. I think a little bit different this time around in terms of what's driving it. We are seeing earnings in some of those, tech stocks, which is driving a lot of the concentration and valuation stretch, so it's a bit different. But ultimately, when we look at our active managers, stripping out the concentration effect, we still generally see them as adding value against their benchmarks. So we actually are spending a bit of time thinking about what's the right mix of systematic, more risk control, lower tracking error managers, your traditional fundamental bottom-up managers, active managers, getting that mix right. And sort of interestingly, going back to probably some of my heritage in options and active management, what is the let's call it the ultimate asset owner's risk or us as investment manager in controlling the risk that those active managers have when you put them together in aggregate. So we have a number of active managers in each equity asset class. We're doing some work around controlling the risk where you do have concentrated markets to just cap some of those potential outcomes you can get in these sort of conditions.
You sort of had an interesting example there where you say you look at the managers when stripping out those big tech stocks. So do you almost take a separate approach where you look at the market X, Mag 7, and then have a separate strategy for that?
Not per se. We were looking at that sort of X Mag 7 active management sort of performance really for interest, and coming back to that question about the role of risk control in that when we do have these particularly concentrated equity markets. But at the end of the day, as you sort of mentioned before, we are benchmarked against your future, your super benchmark. So ultimately, that's what we're aiming to beat. So for us, it's what is the right mix of systematic sort of quantitative managers, which have actually done quite well in this environment. They've been generating outperformance. Your fundamental bottom-up active managers, which have found these concentrated markets hard, just finding it difficult to buy those highly valued tech stocks. And then, of course, what's our role as the ultimate owner of that mix in terms of managing that risk. So we've got a really fortunate at MLC to have a really strong derivatives team capability within my investment team. So they're putting in place some derivative strategies, which is somewhat complicated. I won't go into the full weeds, but we dispersion trades where we put a trade on which basically looks at the dispersion of the Magnificent Seven stocks to a basket of, almost call them inverse Magnificent Seven stocks. And if that correlation widens, we get paid either way. So it's non-directional. So we're doing things like that. Is our role to sort of try to look to manage some of the risk at the total equity asset class level.
Yeah, so I think we've spoken about that trade a little bit earlier in a different interview. So you still have that on? Is that how you deal with sort of the potential of, is there an AI bubble?
Yes, we still have that trade on. It's not as big as we would have liked it because it's been a very successful trade. And we have that on, and we're looking at other outperformance options, different sort of trades to put that in place. Now, what we want to be careful of, we're paying our active managers active fees, and we don't want to just undo the positions they have on. So we're trying to get non-directional, non-linear positions where we take some of the risk out of those positions. So if the AI stocks continue to run, we benefit where our active managers may be a little underweight some of those, and vice versa. If the stocks fall, we're not undoing the manager's trade. We get that performance back. So in aggregate, I should say our equity performance in global equities, which is most pronounced with concentration for our largest fund, which is our MLC My Super fund, has actually been adding alpha because we have 60% of that international equity exposure in systematic strategies, 40% in traditional fundamental active, and then we have some risk control over that. So in aggregate, we've actually sort of outperformed in that portfolio through this environment.
And I think that derivative capability, that came from the merger between IOOF and MLC.
Yep.
So previously there wasn't that capability there. Did you sort of, from your early days, having already managed derivatives, did you sort of thought like, finally, I now got this extra tool in my toolbox?
Yeah, it was terrific coming in as being appointed to CIO of the joint group, because there was a lot of great capability. The really strong private equity capability in MLC, really strong alternatives capability in MLC, and then the derivatives capability. Was really exciting for me. As I said, it's a space that I used to be in my sort of younger days and could see the value in applying derivatives to manage risk. And the team, really had a strong capability. They're doing a range of things. They're more traditional, just FX hedging. That's more your sort of trading. But as I said, some of these risk management positions, which really do tie into both our dynamic asset allocation positioning. So the derivatives team are certainly in and around our thinking on how we want to position our active asset allocation and come up with ideas rather than just doing a straight cash physical tilt. Can we execute that either through derivatives or futures in a more efficient way, or give us a different payoff that sort of suits our view? And then also down, as I said, down at the asset class construction level, where we may have industry biases, country biases. For instance, another trade that another sort of piece of work that team helped with was a banking basket we saw in one of our portfolios, Aussie banks.
Yep.
somewhat expensive. So that team sort of was in and around building a basket
somewhat
of foreign.
Expensive. I think CBA was the most expensive bank in the world for a
I
while.
was probably being a bit polite, but yeah, it was very, very expensive. So we actually built a basket of foreign banks that kind of proxied Aussie banks, put some risk around it, and use that as well to sort of solve for some of our asset class construction positioning that we wanted to fine tune.
Are there any sort of other trades like that you're currently looking into that haven't been put on yet?
Well, we're looking at some outperformance options.
Yep.
Looking at that, we are doing a bit of work, as I sort of hinted at, around when we look at our active manager portfolios in aggregate, and we believe in active management. Where we do get into these markets where concentration is pronounced, do we want to control for other things like country? Is a simple way to manage some of that risk just country risk. I mean, when we look across our active managers, generally underweight the US. If you just controlled for that risk at an overlay level, what improvement that makes. So we're doing a lot of work around that sort of piece. And I think that dispersion trade idea or dispersion option that I talked about, it's got other applications that we're looking at, but it doesn't work all the time. It depends on pricing, depends on the basket you can put on, but it's that sort of. It's really trying to keep the deep diversification that we want in our portfolios, but just adding a bit of extra layer of risk control down into the portfolios.
Yeah, the other capability that you mentioned was the private equity. What is sort of your view from an asset allocation perspective on private equity as an asset class? Because we have seen some problems with being able to exit companies and having to set up continuation vehicles. What is your experience?
The experience has been good, and I should say winding the clock all the way back to that sort of Telstra Super. I mean, my boss, Steve Merlicek, was very keen. We were sort of early investors in private equity way back in the Telstra Super days. IOOF, we started private equity, and then, of course, MLC acquisition comes along, and hey, I've got find myself with a great existing private equity capability. So you can get a sense I'm positive on the asset class. It is a long-term asset class, so you need to bear that in mind. And I look back on the performance of the MLC private equity capability, and that's we've got 4 people in New York, 6 in Australia, so it's a reasonable commitment the business has made to that. And that team's basically establishing really strong GP relationships for the fund investments, but then also about 40% of our private equity exposure in our largest MLC My Super Fund, 40% of that private equity exposure is co-investments. So the team does a lot of detailed work on co-investments and getting A, those really good opportunities, and B, at a more attractive price point. So private equity, and look, Your Future, Your Superland, private equity is benchmarked against listed global equities, which has been a particularly tough benchmark over the last few years. But I think you really need to take a longer term perspective, if you can, to look through those periods. So I look at our private equity program. I think it's outperformed listed equities, including the rally we've had recently, by around about 3% per annum over the last 15 years, including the run up we've had over the last couple of years in listed markets. And then the private equity program, like, we're starting to see activity. We've had a patch where exit activity has been quiet, as you sort of noted there. In our program, we're starting to see exits pick up.
Okay.
Some of it is to continuation funds, not our continuation funds, but others. So we're starting to see some exits there. And we're starting to see the return profile sort of pick up again with that activity, which is great, and we expect to see that. And there's I think there's some real kind of permanent structural reasons. We're in the sort of more lower mid-market space. So, gearing is not such a prominent feature of the sort of value proposition in private equity. The value proposition is really around pairing up with great GPs, usually early in their life cycle as a GP. So we're an important investor in their funds, and really making sure those GPs are very active in the terms of their management interaction with their underlying businesses. So really getting strong management teams in, reshaping the businesses, helping those businesses, back with their own strategic plans and their own mergers and acquisitions to sort of really grow those businesses. So we've seen that value come through in our private equity program more through sort of the EPS growth than, let's call it, financial engineering.
Yeah. And when you look at private equity as an asset class, I mean, you run multi-asset portfolios. What is sort of the role, and how do you tie it back to other asset classes? And one of the reasons why I'm asking this is because recently I did an interview where they basically said, okay, if we look at a portfolio at the total level, not necessarily TPA approach, but if you look at the total portfolio, private equity is very growth orientated. And so what does that mean for your equity holdings? Are you going to have a bit more of a skew towards value style, a bit more conservative equity, or does that not tie together for you?
Look, a little bit. So obviously when we build the total portfolio, as you say, we run through the typical capital market assumptions, strategic asset allocation process. So, and we're solving for, when we're thinking about the allocation of private equity at the top level, we're solving for a lot of things. Liquidity, how much liquidity can we bear? The reality is, what's the sort of fee load that we want our portfolios to have? The optimisers, in a purely quantitative sense, the optimisers love private equity because it's lower volatility, and it has our capital market assumptions do have an excess return, which it has delivered. So we tend to be so we'll tend to hold in most of our sort of, call it balanced to balanced growth portfolios, kind of 5% allocation of private equity. So it's meaningful, but not massive. In terms of what does that mean for our the rest of our equity portfolios, we probably don't think about it so much in the sort of value growth factor sense. It is, our private equity is mid-market, so we probably think about it in a bit of a market cap sense. So how much do we want in our listed equities in that small and mid? Probably where it does show up is more in the sort of total risk. I mean, private equity is always going to be, given your Your Super benchmark, a very high contributor to overall tracking error, just because there is kind of a mismatched force with the benchmark that you're going against over shorter periods. So hence things like, as I said, we have 60% of our global equities in systematic equity strategies. So they're not passive, but they're taking, call it 50 to 80 basis points of tracking error, and far more risk controlled. So you sort of got a much better handle on what sort of benchmark risk you're going to get out of those managers compared to your active managers. So it shows up in that sort of mix of the styles we run our active equity portfolios in.
Yeah. And recently we spoke about you doing a bit of a review of the My Super option and looking to increase growth assets a little bit there for younger members. Does that also translate in more private equity in those options?
Not necessarily, and we're still working through that work. So our corporate super team are doing a broader enhancements across our sort of master trust My Super offerings. So working through that, but it wouldn't necessarily lead to a bigger allocation to private equity.
Fair enough. Now, you mentioned earlier there in your Telstra Super days, you worked with Steve Merlicek, which he became CIO there, and then I think you followed him to IOOF afterwards, where he became CIO, and you joined him. How was it working with him, and do you see him as sort of a mentor, because it was still the early days back then?
Yeah, certainly do. And Steve was great, and I keep reminding Steve he dragged me across to IOOF. He brought me across to IOOF for follow. So Steve was certainly got me into IOOF and that sort of side of the market. But Steve's a great mentor. I still see Steve regularly, and he's just investments in his veins, so to speak. So he's always talking about individual stocks he's looking at and investments that he's making. So he's sort of super active, and I think Steve really. My time with Steve at both Telstra Super and IOOF MLC, Steve probably taught me a lot of important things around team and managing money. So he had a few key sayings. Keep it simple, stupid was one of his favourites, which was really around we're here to add return, stay focused on investment outcomes, which sounds obvious, but there's a lot of distractions in the industry. So Steve would always pull you back to, well, what does this mean for the portfolio? What do the investments look like? And I've tried to keep that. Another good sort of saying that he had, which I've continued to follow, is hire people that are smarter than you. And I could say, well, that's not hard for you, for me, but it is important to hire really good people and be confident to give them space and empower them to do what they do.
Yeah.
So Steve was, I think really integral in just some of those basics around investments. And I think probably one of the big positions we put on back in those days was a currency position. So Steve was very much sort of encouraging the camp. If you've got a conviction in investment thesis, make sure you have the courage to follow that through. Obviously, take the risks into account. No one has perfect foresight, but if there's a position you have high conviction in, make sure you reflect that and have the courage to put that in the portfolio. So, e.g., when the Aussie dollar was well above parity against the US dollar, Steve sort of took a position to go zero hedging, which was, worked out really well, but that was pretty bold position at the time. So those sort of examples of back your conviction. So Steve was a mentor for sure.
Yeah. Does he have any sort of influence in how you now, your style as CIO, and do you sort of, how would you define your way of running an investment business as CIO?
Yeah, and look, there's a few different aspects to being a CIO today. I think certainly in the investment part. So I try to, and this might sound a bit strange, but I try to make sure I'm actively heavily involved in the investment side. So going to all the investment meetings and being involved, but not necessarily dictating micro terms. So I sort of see my role as twofold. So being in and around the investment strategy, making sure the actual investment process, strategy, the way we make decisions is working well. How do we think about making decisions? What are our approaches to making decisions? So that very high level, is our strategy really strong and our process really strong? And that's been probably particularly important in my sort of CIO career, where we're at the IOOF Insignia MLC role. We've had a lot of growth through acquisitions and mergers, so bringing teams together. So just making sure the process is strong is an important part of my role. And then obviously getting involved in the actual sort of investment decisions. And I sort of see primarily my role is to sort of challenge some of the discussions, come at things from a different perspective. I'm talking to different sets of people than my team are, sort of putting some different ideas in and challenge the process to make sure it's robust and try and make sure we've got good thinking in the sort of day-to-day decision making. And then ultimately, if there's hard calls to make, they'll flow up to me to sort of make those calls. So that's sort of the investment piece. And then there's obviously managing the team. And as I said, like you need, without a really strong, capable, empowered group of sort of talented investors around you, I don't think any CEO is going to succeed unless they have that support around them. So making sure the team are free to focus on what they need to focus on. So help to the degree possible, try to shield from a lot of the noise that's in and around businesses, and give them a good empowered environment. So I really try to empower my senior investment people to take ownership of their portfolios, which they do, and sort of really drive a lot of the decision making with me coming along beside them. So making sure I've got the right people and they're in the right environment to make strong decisions.
Yeah. So my colleague Tech, he recently explored the idea: is the CIO of today a manager or an investor? But from your answer, I get you're sort of both, or somewhere in between.
Try to be. I like to think it's a bit of both. Like I don't think it's very hard to be a purely investment, I think, these days, because you do have to manage the team, and there's also regulatory environment, everything else that comes with the role. But my passion is ultimately the investment part of the job. I love looking after the team. I'm lucky to have a great team around me. But it's a bit of both, and I think they are interrelated. So I think strong investment outcomes is part of having the team hopefully in the right headspace with the right structure to help support that investment decision making.
Yeah. So how much delegation do you have in terms of delegation from the IC and the board? Because you mentioned earlier Steve was very much about conviction, and if you have high conviction in a trade, you should explore that. How much room do you have to implement conviction trades?
Yeah, and I think we're lucky with our boards and committees that they give us an appropriate amount of delegation, and they understand. A lot of our committee members, both from our super fund trustees and our investment manager trustees, have been in markets in some shape or form themselves, so they understand the practicalities of running money effectively. So, we have delegations around asset allocation ranges. So myself and the team are able to move within predefined ranges around our strategic asset allocation. Varies, but call it sort of plus or minus 10%, so quite reasonable ranges. Now, we don't sort of necessarily use those full 10% ranges, but we're able to move around without having, we report everything back up, obviously, but we don't have to go up for sort of those asset allocation moves. We can reweight managers within ranges. Hire and fire, depending exactly where the manager is, but hire and fire would typically go to committees for that sort of manager hire fire function. But we do have delegations. The committees have given us delegation for many of our funds. If there's a manager where the team's walked out and there's a real problem, that I have authority to exit that manager straight away if it's a situation where it doesn't make sense. It's a clear-cut case that we need to get out of that manager. So we get quite a bit of delegation, and the committees get very interested in how we position, etc. Good. Well, I'm very lucky in the good committees that sort of understand how these things work. They get involved where they need to be, and they'll often get involved where it's policy, strategic stuff, as opposed to sort of the day-to-day minutiae of how the portfolio is run.
Because I think delegation is one of the things that people look at when they starting to implement TPA, the total portfolio approach. It's a bit of a buzzword these days. What's your view on TPA? Are you trying to implement it, or?
Well, it's an interesting one, and probably each person you ask about TPA has got a different definition of what it is, without sort of sounding too flippant. But look, I think at the end of the day, everyone's running some form of it. Like we ultimately live or die by how our total portfolio outcome operates. So we don't have a strict form of TPA, but certainly asset class PMs, when they're building their portfolios, interact very closely with the diversified PMs. So I very much quite like as flat as possible team structure, so we don't get too siloed in that we have an investment team member that's running a particular asset class that doesn't. What I don't want is to have people running, parts of the asset class portfolios where they don't necessarily understand the drivers and dynamics of the top level diversified PM. So we have quite a flat structure, and really try to make sure that the asset class PMs feel a high degree of ownership on their portfolios, but they understand, when we sort of almost call the diversified PMs their clients. They want to understand their sort of clients' needs of what they're building at that top level. And that dynamic's working well. There's, I think, you always want a little bit of tension between, this is a great idea at the asset class level, at the top level, but I've got that risk elsewhere, and having that dynamic. So I think we've got a pretty good operating rhythm there. I think two of a stringent implementation of that sort of total portfolio can create its own set of problems if it gets too strict and too fragmented and too siloed, because it becomes, I think, a bit of a sort of capital allocation challenge at the top if you're not getting that dialogue across teams. So we absolutely look at the total portfolio level, but we try to do it in a more of a sort of flat team structured way.
Yeah, because one of the things when you look at sort of different approaches to TPA is that it's this effort to get everybody to think about, what impact does the investment have at the total portfolio level? And sometimes I think, isn't it the CIO's job?
Yeah, it all comes up. That's what. So we do that. That's about feeding that. It's really communication, that you want to have that communication between where that asset class PM's portfolio is ultimately landing and what role is that having at the total portfolio level. And we absolutely measure risk, the contribution to risk from all of those portfolios, the managers in those portfolios. So we have very good, as you'd expect, very good transparency through to where the risk and alpha is coming from. And then my role as CIO is to try and make sure we've got great communication channels, and there's constructive and healthy sort of tension between asset class PMs. This is a great idea, we want to do it. Diversified PM, hey, that might not fit because of this reason, and just making sure we're keeping that. No one's getting lazy in the process, which they're not.
Yeah, for sure. Yeah, we spoke earlier a little bit about the impact of the technology stocks on the equity markets. But if we look sort of broader at AI, do you see a role for that in sort of your day-to-day job in the asset management industry?
Yeah, the use of AI, and it's a topic actually my leadership team and the whole MLC Insignia Business has been looking at is, which I'm sure most businesses are, is how do we implement this? So we've been doing a lot of work in the team just on a few things. How do we use existing tools that we have in the AI tools that we have in the organisation, just for, let's call it efficiency, just speeding things up, which every business, and I think that's probably going to be, from an investment point of view, a bit of a theme next year as we start seeing a bit of that efficiency turning up in either cost saving or ultimately in margin in businesses next year. So in our business, we're doing a lot of work just on the efficiency part. We're trying to challenge ourselves to how to think bigger and beyond just the efficiency piece, because I think that's just almost has to be done. So what does it mean for how markets are invested? And you've seen in the past, we were talking before about indexation, as a passive as a strategy. I'm not quite old enough to have been there, but sort of old enough to be around it, that running passive money was actually probably a technology issue when you look back long enough to get the data of what's the market cap of each stock. How do you weight the index before you had? So as technology grows, how we invest can change. So we're trying to think a bit bigger about, well, what does it mean for your traditional active management? Does it become more about how much data can a manager scrape and apply some reasonable AI to it? So don't have any strong outcomes to that thinking yet, but it's something we're sort of alive to, that the way at the end of the day we're processing information to arrive at a decision, does the dynamics of that change? Is it about how much data, how much information can you get? What AI logic, what else can we apply to that to arrive at investment outcomes? So I think that'll be, for us, a really interesting space over the next 10 years really, but
So are you looking there into, is it harder for active managers to have an information edge, or to gain insights that other people don't have?
Could be, and that's what we're trying to think about. And it doesn't mean those active managers will evolve as well, many of them. So it's about how do they evolve? Does it actually create new and different opportunities for those managers as you get that sort of, let's call it, data richness improve, and AI sort of injecting itself in different ways into the process? It will just mean they need to be, and us need to be alive to that as it evolves.
Because one of the applications that I found was interesting as well is that fund managers have been using it as a learning tool as well, where if they look at a new sector, it might have taken weeks to come up to speed to know exactly how all the supply chains work and what sort of the key elements are. But these days you can get at a reasonable level in like a matter of hours. Do you see a role there?
So it's almost not quite a graduate in your pocket sort of thing, but it's a little bit like that. So your basic sort of, provide me a written summary of this particular industry or this issue. Now, we're highly conscious that you have to have someone interpreting that with some degree of knowledge. Like there is, if you just took that as verbatim truth, that would be a pretty risky approach to take. So we've had a few experts come in and just remind us that AI is not always factually correct. It can sound convincing, but it may not be correct. So we're aware of that. So we are using that, but in a knowledgeable way, and that we have senior people looking clearly applying judgment over the top of that. And really the day-to-day at the moment is probably one of the things that, as we've looked into this, it's become more apparent to me is distinction between it just AI and automation as well. So we've sort of had a lot of things, let's get AI to do this for us, and as we've looked at it, well, really this is just an automation project. So it's interesting kind of where the slice where AI will come in first.
Yeah, the information it supplies, you always have to check it a bit. It's not just hallucinations, but it's often also just plain wrong. I was doing an exercise yesterday where I looked up the bio of another CIO of a different company, and the first result was, of course, an AI summary, and it plainly told me that this person was the former CIO and had left in 2021. And no, he's still there. He's been there since the last 10 years. So I'm not sure where this information comes from. But
well, that's the thing, and it sounds very convincing. So it's tread with care at the moment.
Yeah. So what's on your agenda for next year?
Look, always a big year. So our CEO's put out a strategic plan, and we've got the investment team's got elements it's more heavily involved in around that. So our private equity capability, which I was mentioned earlier, we're really keen to grow that into new channels for a few reasons. We think it helps support the program. That program benefits from fund flow, being bigger participant with those GPs, helps us get greater access to co-investment. So we're looking at private equity. We've launched a co-investment, or closing a co-investment fund 4. We've got a private equity retail, sort of always open evergreen fund, which is growing and performing well. And thinking about our which is another sort of initiative that we're pursuing, our managed accounts business, which is growing very well. It's just ticked over, I think, $4 billion in our last update. Thinking about ways private equity alternatives can be sort of safely built into that managed account program, because those asset classes have been really good contributors from both a return and risk perspective for our diversified funds over very long sweeps of time. So we would like to get our managed account members access to that. So we're thinking about ways of pursuing those opportunities in a very sort of managing liquidity, managing all the various risks that come with that. So that'll be.
I hear some echoes in there from sort of current discussions on private credit and liquidity and offering it to more the wealth space. Is that sort of the issues you think about?
Yeah, we're thinking about that, and we're thinking about it really, or the piece I'm thinking about with the team is offering that in a diversified managed account where we're controlling the asset allocation along with our clients and the construct of those. So it's how do we do that in a methodology which addresses some of those, making sure liquidity at the total level is managed, at very sort of comfortable levels, making the valuation policy is strong, which it is, that the valuations are coming through. So all of those topics, but at the end of the day, we look at it and go, what would generate a better outcome for our clients? And we're running the private equity, we're running alternatives in our main MySuper funds and our wholesale funds, performing very well, important component. So the challenge to us is, well, how do we make sure all our clients can get access to that in a very thoughtful way?
Yeah. So you're not offering daily liquidity on these private equity funds, or?
No, not the standalone. No, so we're around all of that. So that's no. And again, it's just about setting those things up properly in the first instance, that they're robust through time for those types of issues.
Yeah. So this strategic plan that you mentioned, I think it's 2026 to 2030 strategic plan. Is there sort of an end goal there where we want to be this big by 2030, or we want to have achieved these type of metrics?
Well, we certainly want to be one of the biggest players out in the industry. From my perspective, in the investment team perspective, it's really about our clients having a great return experience and feeling very confident in the process. So we've always thought if we can deliver great outcomes to our clients across all the different products we offer and be transparent about how we're doing that as much as possible, help the clients understand what we're doing in portfolios, and we've got a tool called Investment Central, which allows our advisor clients to look into most of our portfolios for the manager's exposure, and we think that really helps build that understanding and trust in the products. Our goal would be to have our clients think, hey, this is my obvious place to go for sort of investment solutions.
Yeah, and I think one focus of that strategic program as well is the retirement phase and having sort of that smooth transition between accumulation and retirement. Now, I did see at one point there is a statistic that MLC is the fund with one of the largest number of retired members. Does that give you special insight into, there's the regulator wanting funds to develop retirement products? Do you sort of have a special insight in what the key elements are that have worked over time for the retired members?
I think I heard a similar stat where I think where the group is the largest pension or retirement income payer outside the federal government. So I think your statistics probably correct. Look, and I think there's a lot of different elements that go into that. From an investment team perspective, it's probably an extension of a lot of things we've talked about. So there's from an investment perspective, it's for our My Super default options is the glide path. We've got the correct shape and trajectory on the glide path. Our diversification. So as you get into the retirement, you want lower volatility. Some of those strategies I've been talking about, like the alternatives where we have insurance-related investments and some opportunistic credit, which are really good diversifiers. They generate good income to create that smooth ride for retirees. So we think about those sort of allocations as we go through the glide path. But it's really much more than that. And this quickly gets out of my area, but it's the digital experience that the retirees have around that. It's things like, is it the retirement boost when you switch from accumulation to pension, making sure they access that, which our members can. And then, optimising the structure of the portfolio, not so much from an investment perspective, but the product, I should say, to sort of optimise the ability to access age pension as you get older. So there's a whole lot of aspects around that sort of retirement piece. And the business is clearly working on that. The Master Trust really going through a good sort of enhancement program around all of those aspects going forward. In large part to sort of create, really do the work now for members in the accumulation phase and those getting close to really optimise their experience in retirement with our products.
Yep, fair enough. All right, well, thank you very much, Dan, for coming to our offices. It was great talking to you.
No, thank you, and thanks for having me. It's a pleasure.
Thank you for listening to the i3 podcast. For more information, please visit our website at www.i3, that's the letter I, the number 3, -invest.com. And don't forget to like, subscribe and review. Thank you very much.